Welcome to Nuggets Aboard. I am George Hoye and I am your host. Today we are going to answer an important question. Shouldn't I always purchase a property in my name? Now, there are many structures in which you could acquire a property apart from being in your individual's name. You could acquire a property and register it in a company. You could also acquire a property and register it in a trust. Now, there are many considerations that you need to come up with before deciding the appropriate vehicle. It is important to establish your goal or your intention in acquiring the property. Is it to use it as a primary residence? Is it to buy and sell it at some point? Is it to lease the property? Are you buying it as an investment property and not going to stay in that property? You also need to look at taxation. What are the implications in terms of tax? If you're going to lease the property, are you aware that the profits are going to form part of your income and you're going to be taxed at the same rate you are being taxed as an individual? Are you aware that there's something called capital gains tax? Your property is going to accrue value. At some point, you may have to trigger this capital gains tax. Are you aware that there is something called estate duty, which you may be liable to pay when your estate gets wound up? What is the wealth flow that you are aspiring to attain in your life? This has got implications in terms of choosing the right vehicle. If you've got a very low wealth flow, you may find that it may be so straightforward for you to own a property in your individual capacity. It is also important to look at the other aspect of estate planning. Right. At some point, we are going to leave this earth. What is going to happen to the assets that you have acquired? You need to think about that. And how are those assets going to be passed on to the next generation? These are all important aspects to look at. And if you do your assessment from the onset, do computations for all these scenarios, you will be able to choose the appropriate vehicle. What type of property are you investing in? Is it a commercial? Is it a residential property? You may have to consider the appropriate vehicle based on the nature of the property that you are going to acquire. And it is also important to look at financing. How are you going to finance the property? Are you going to pay cash? Are you going to use a mortgage? All these aspects have got implications. What I would propose is, before you buy a property, do computations, especially when it comes to taxation. Look at all the possible taxations and fees that could be kicked in different scenarios. What are the different scenarios if you were to decide to sell the property? If you were to decide to lease the property? If you were to decide to keep the property and eventually pass it on to the next generation? Once you have done all these computations, you are very much close to choosing the appropriate vehicle. Now, there are three possible vehicles that we will look at that one can utilize when acquiring a property. And within these three vehicles, we're going to look at some of the considerations that one has to look at. If you are to acquire a property in your individual capacity, you'll find that you're going to benefit from low or minimum setup costs. You generally will have full control. Another option will be to have the property owned in a company. There will be more cost associated with setting up a company. Obviously, you need to register the company with the appropriate entities, and then you need to do annual returns, and in most cases, submit financial statements for that company. Another option will be to buy a property in a trust. Again, the costs will be higher. You'll find that you're going to need to pay costs to set up your trust. And in most cases, you're going to need a trustee coming on board who is a legal-minded person to help you in administering that trust. And there are also statements, financial statements that you need to submit, as well as annual returns. In terms of asset protection, what you will find is there is a risk that your assets might be attached if you are sued, if you own them in your individual capacity. There is some protection if the assets are owned in a company. However, if you are the single shareholder, or if you are a director and your conduct might have affected the company, you can have your assets attached. So it's important to structure the company well if you're going to acquire property in a company. Within a trust, you find that generally the assets of the trust are protected, right? There's clear separation from the trust and the individual. So this is the vehicle where you have the most protection for assets. Then there's an aspect of capital gains tax. If you own a property as an individual, what you will find is, for example, like here in South Africa, you will be able to get an exemption for up to 2 million. And if you are a couple, it means that you could get an exemption up to 4 million, provided it's your primary residence. Now, this may be beneficial because you're going to pay the least amount. However, if you were to decide to own a property in a company, you are going to likely have to pay more taxation or more taxes if you were to dispose the asset. There's no discount that will be applicable in a company. And then on the other hand, you could buy property in a trust, and in a trust, what you'll find that if you employ vesting, it's possible to benefit from the discounts, especially if it's going to be used as a primary residence. And there are also ways in which you can dispose the asset without triggering, or there are ways in which you can pass the asset without triggering capital gains tax. And then the other aspect is about tax flexibility. Within a trust, you have the highest flexibility. You could distribute income to the lower or the least earners. Within a company, it's medium, the flexibility, and it's very much possible that the income tax might be lower than what one might be paying as an individual, especially if this property is going to be used as an income generating asset. It's also possible, however, that depending on the value of the property, that you may actually be paying less in taxes if you are taxed at a lower income rate. Then there is the other aspect of estate planning. If your property is in your name, you just, in most cases, just need a will, and it's basic. However, there are some fees that will be paid in terms of conveyancing when your property needs to be transferred. It's a bit more complex in a company, and in most cases, if you're the single shareholder, you may find that your assets or the properties that you own as part of the company are also accounted as part of your estate. Within a trust, there's high flexibility when it comes to estate planning. All right. If you're going to look at lending, you'll find that different lenders have got different approaches, but it tends to be easier to apply for financing in an individual capacity, especially if you are a first-time buyer. However, it's also possible, if you're going to be the surety, to make it easy to buy a property for the first time in a company, as well as probably in a trust. So the trust will tend to have more requirements when it comes to apply for financing. So it's not entirely impossible, but it's more demanding. So it is important to factor all these main aspects, do the computations. And once you have done the computations, you choose the appropriate vehicle. There is another mechanism in which you can employ what is known as a hybrid model. This is, for example, where you can have your property being acquired by a company whose shares are held in a trust. Now, this allows you to benefit from the advantages of owning a property in a company, such as a lower taxation rate, and still benefit from other aspects that are found in a trust, such as estate planning and taxation flexibility. All right. So this will give you both worlds benefits. Yes, it also comes with extra maintenance and setup related costs. But if you're going to have a wealth flow which is above the thresholds you find in terms of capital gains or estate duty abatement, you will find that it may be the most appropriate route for you to choose. So get your calculator out, get your scenarios drawn up, punch those scenarios, and let the scenarios help you to identify the best vehicle. Look at taxation. Look at the asset or your wealth value or your estate value. Look at the fees that may likely need to be paid. And also look at financing. Once you have done all these analyses, you will be able to choose the appropriate vehicle. I want to invite you to like and subscribe and follow us for more updates of this nature. Goodbye.